Hello, lovely people out there. How are you all doing? I'm Kate Hill and welcome to another special monthly city market update, this time Sydney and New South Wales. Now, we do give you the best, honest, balanced commentary and content on our channel. So before we do anything else, please subscribe to our YouTube channel. Hit that notification bell so that you're not missing out on all our videos and posts as soon as we post them. And as important, if you are enjoying our free content and you are finding it useful, please click on that all-important like button too. We do really appreciate your support. Now, for those of you who know me, you can totally skip this intro, go right here to get straight to those juicy bits. For those of you who are new to the channel, welcome. I am so happy that you found us and please do keep watching. To explain what qualifies me to be sitting here and talking to you about property buying, owning and investing, like who the heck are you, Kate? Well, I am not an amateur basement YouTuber. No offense to all of you out there, of course. But me and my team are professionals and we have been in property for a really long time, advising and helping people. We have seen most things happen. We've gone through cycles. And most importantly, we own and invest in property ourselves. We walk the walk. We are a rare breed because we are also qualified property investment advisors. We don't get paid by anyone to sell property. And we genuinely care about empowering you to get the best results for yourselves. We are experts at what we do. We attend auctions, we analyze and appraise and buy property. We are out there every day, 24/7 at that property coalface. And if that hasn't convinced you, I do not know what else I can tell you. You can watch my video here. I've also listed it in the description below for the most recent National Australia house price update. So getting straight into the Sydney city market. Major bank economists are now revising their growth forecasts for the Sydney property market and are a lot more bullish about what's happening here moving forward, having originally forecast major declines in property values. Westpac, CommBank, AMP Capital and others were tipping up to 30% declines in prices back in March. This hasn't happened yet. And the latest price data shows just how wrong they were. It's an economist's job to make forecasts, of course. But Sydney house prices on average fell just 0.2% in September and 1.7% in the September quarter. In the year to date, Sydney house prices on average remain 1.5% higher than at the start of the year and are still 8.7% higher than a year ago. 7 months into the pandemic period, Sydney is weathering the storm pretty well so far, and one of the main cities to prove the economists and journalists very wrong. So this does mean that the mainstream media's tone of reporting about the housing market in Sydney and actually elsewhere has changed dramatically recently. After 6 months of completely relentless negativity, crashes here, prices declining there, with repeated forecasts of prices collapsing, the media has actually now been forced to take a different line because this just hasn't happened yet. Terry Ryder's latest Ryder report summarises some excerpts. And here is a 4th of October article published by domain.com.au, which is part of the Fairfax media empire, which includes the Sydney Morning Herald and The Age. Home buying hopefuls could be in for a rude shock with strong buyer demand tipped to stabilise Sydney's property market and even spark price growth by the year's end. Home prices have defied expectations in recent weeks as finance-ready buyers who went quiet during the lockdown have since come out in force to either buy their first home, upgrade, or sell out of the Sydney market for a tree change. Value declines have already slowed from the height of the COVID-19 pandemic, slipping just 0.2% in September, the smallest drop since March, based on CoreLogic figures released on the 1st of October. Moving on to auction clearance rates. Auction clearance rates are continuing to rise. On the weekend of the 26th, 27th of September, Sydney recorded its highest auction clearance rate since March, with agents reporting a shortage of stock, strong buyer demand, driving encouraging results for sellers. Then the following weekend, the 3rd and 4th of October, the preliminary clearance rate reached 72%, close to that of previous highs in March. Last week, Sydney was host to 754 auctions, up from both last week, the one before that, when 430 auctions were held, and this time last year when 733 homes were taken to auction. Of the 587 auction results collected so far at the time, 429 were successful, which is similar to last week's preliminary result. Agents have reported high crowd numbers, with sometimes so many attending that they had to turn people away to comply with social distancing requirements. I can totally confirm this because, as I've said before, we are actually out there. I was out there this weekend doing inspections for clients, and there are a lot of other interested buyers out there inspecting and making offers. So yesterday, for example, I'm inspecting homes for our home buyers and for our investors, and it is busy out there. There is definitely a lack of quality stock as well. So overall, the combined suburb vacancy rate for Sydney sits at 3.5%, but it is very tight in the suburbs and very high in the inner city rental market, as you'll see here, and then also here. More on that later. So we can say, as we've said before, that much of Sydney real estate has defied the doomsayers by still achieving price growth over the past 12 months, despite the decline in recent months. Prices have remained stable despite increasing unemployment levels and significant residential vacancies in some of those inner city locations. So looking forward, for example, we can assess some of the markets out in Western Sydney, which was the leading light in Sydney's recent property boom. Good population growth, infrastructure spending, and a strong economy also fueled Sydney's most recent revival after the boom out there in Western Sydney. First home buyers were and remain particularly active and have been keeping markets strong in these more affordable areas of Greater Sydney. And also the banks were and are still lending to first home buyers more generously than investors. The best way to find future growth is by buying property that lies in the path of progress, i.e. by following the infrastructure trail. It really underpins values and drives future growth. Much of the future spending will be directed towards the west and the southwest in Sydney. Western Sydney alone is considered Australia's third largest economy. If anybody knew that, I think that's incredible. Think West Connex, the Parramatta Light Rail project, the new airport at Badgerys Creek. Over $22 billion is being spent on infrastructure in the transport area in this region, just in the next 4 years. The New South Wales Department of Planning forecasts employment in Western Sydney to grow 47%, compared to just 36% in the rest of Sydney over the next 20 years. Now, these are all compelling figures, but let me just focus on the airport alone. This precinct falls under the jurisdiction of the City of Liverpool. It is destined to become an economic powerhouse because of that new airport. The region surrounding the airport has been nicknamed Aerotropolis. The whole of this area is being developed into an employment hub to include the $5 billion Sydney Science Park, and more billions are being spent on road and rail infrastructure. The airport is forecast to take 80 million passengers a year, which is twice the number currently serviced by Sydney's current airport at Mascot. Think of the number of people they're going to be servicing there. Completion is expected by 2026. Population is anticipated to swell to around 300,000 by 2036 out there. And in this particular area, population growth is consistently above the national average in the last decade. We do obviously really like this area around that airport, but you need to know what you're buying and where you're buying it so that you are buying the right property type in the right location. I'm stating the obvious, but this is so important. But that is what we do every day. It does remain to be seen whether the boost to the infrastructure spending will balance and outweigh the loss in population growth that will result from a loss of overseas migration that Sydney benefits from. But then again, Sydney has never overall been the nation's population growth leader. For Sydney, our warning for some inner city unit markets remains in place. Large numbers of units are listed for rent at the moment in some of these suburbs. Inner Sydney's unit rental market, as well as Melbourne's, has been one of the hardest hit in Australia during the pandemic, with vacancy rates rising, rents dropping, a substantial drop in foreign student numbers, all those unoccupied Airbnb properties flooding the market, and the shutdown of overseas tourism during COVID-19 has absolutely led to growing numbers of landlords having to seek secure permanent tenants for their properties in the inner city areas. There is a sharp reduction in rental demand within these locations, and this is resulting in obviously lower rents, extended vacancy periods. This, of course, ultimately has a negative effect on sales prices because there's just no demand. And given that particularly investors are concerned about rental returns and also whether there'll be any upside to capital growth in the next few years. So please, for multiple reasons, beware of this market. Moving on to the New South Wales regions. Many locations across regional New South Wales did enter our virus shutdown period with rising property markets, and the best of them are really well placed to perform well in our recovery phase. Many regional New South Wales areas have had few coronavirus cases, and some of them had 0 cases. And many of these more rural communities have local economies that are really well set up to do well in a pandemic period. The key question, of course, is which of these areas are best suited to withstand the impacts of the virus shutdown and emerge strongly on the other side. So just a few examples. Large spending by the government on infrastructure really is set to boost many of our regions. The funding was included in the federal budget on the 6th of October, and we've reported before as part of a $2.7 billion investment in transport infrastructure across the New South Wales state. The federal government will contribute $920 million towards the completion of the Newcastle Inner City Bypass and the Singleton Bypass projects. An additional $491 million in federal funding has been pledged for the Coffs Harbour Bypass. The Coffs Harbour community has been waiting decades for this bypass, and it is the last major section of the Pacific Highway upgrade to be completed. The Hunter region provides another good case studies. We do think that the Hunter economy, with its strengths in agriculture, viticulture, mines and energy, is well placed to do well as New South Wales emerges from the pandemic restrictions. Albury, at the border with Victoria, had good growth momentum pre-virus and has an economy particularly well suited to handle the current circumstances. Its main job sectors are medical, supermarkets, the military, aged care facilities, and more. It's been a very solid regional city which offers safety to investors as well as affordable prices, attractive rental yields. West of Sydney, we look at Orange, which has a growth market with sales activity rising strongly in the past 12 to 18 months, and the median house price up 6% in the past year. It too has a strong economy, it's very diverse and well placed to handle virus impacts and emerge strongly on the other side. $250 million was pledged to redevelop the Orange Hospital. Mudgee has recorded good growth in its median prices for both houses, which are up 8%, and units up 13%. Its economy, based also on agriculture, viticulture, mining, is another that has many of the right elements to succeed in difficult times. Queanbeyan benefits from being just 15 minutes from the centre of Canberra and is the only Australian capital city to produce house price growth every month over the past 6 months. The suburbs of Queanbeyan provide affordable alternatives to the national capital. So some of these growth charts that you've seen as I've been talking, they are pretty compelling, right? As we head into the spring market, traditionally a strong period for the buying and selling of real estate, we continue to monitor property markets very closely to see what is actually happening as government stimulus packages lessen and the banks review borrowers' loan repayment holidays. Please do subscribe to our channel, hit that like button so that you're not missing out. You're getting all our content as soon as we post it. Do leave me a comment below. Let me know if you've got any questions or concerns, any suggestions as well. And I will see you again really, really soon. Bye.